G'day folks, welcome back to another update. Today we're looking at high-grade copper and US crude. Now copper is showing a bullish momentum on the daily charts and US crude is showing bearish momentum. Before you go any further, make sure you hit that like and subscribe button to support the channel. Also don't forget to reference the +1 videos which go in a deeper dive into the trading strategies we cover today. In terms of the outlook, as of October 2nd, copper fundamentals remain stronger than oil, supported by structural demand from electrification, renewables and infrastructure, alongside tightening supply from mine disruptions and declining ore grades. Prices show an upward bias but face risks from tariffs and weaker growth. By contrast, US crude oil faces a more balanced to slightly bearish outlook, pressured by ample shale supply, easing OPEC cuts and slower demand growth, with only geopolitical shocks or tighter capacity offering upside. So looking at high-grade copper first. Now on the weekly, we've got the prices above the moving averages and the CCI is broken into that moving average range. Now if you're trading on the daily, we always go in the direction of the weekly, so you want to make sure that both the CCI and the prices are above the moving averages. And after that happens, I'd like to see the moving averages start bending up like they did back here, which helps you give you a more confident bullish momentum. So at the moment, I'd call that a neutral positioning on the weekly. On the daily, it's already bullish. So if you're trading on the hourly, we look at the daily trend. So in this case, both the prices and the CCI are above the moving averages, giving us a bullish momentum. And I've marked here some arrows where you would have gone short during that period and started going long during that period if you're trading on the hourly. And then on the hourly, what we look for now is any closer divergence. Now back here we had a bearish divergence, lower highs on the CCI versus higher highs on the price. That pulled back and hit our 23-38% Fibonacci range. And that Fibonacci range, for those new to the channel, is measured back before that divergence started. And that's at 23-38% as a minimum. In this case, it fell down to the 61%, paused there initially at the 50%, and eventually fell down to the 61% before bouncing. And that happened to be also our support level at 47,526. Now, since then, the price has retraced back up to where that previous high there was. Now, what we also look for more recently, we see if there's any divergence. So what we look for is, you can see that's a higher high on the price, and the same period back there, that's about a double top, almost a slightly lower high on the CCI. So that's a bearish divergence. And if this was to start falling back, we take it back to that low there, and we expect the target this divergence target to be hit at that level there. I don't trade these divergence. I basically look at it potential exit. If I'm seeing a bearish divergence and I'm going long, I look at it as a potential exit to take profits off the table. But as I said, this is the minimum retrace. If it does retrace, it could bounce out of that, or it could actually fall further like it did back here. But at the moment, it's a bearish divergence. Just be mindful of that. Now we're also going to look at the back test. And what I've got here, according to the daily chart, we would have gone long from about the 28th of August, which is this period back here. So we again trade in the direction of the daily, but when both the price and the CCI are bullish. And here we look for any divergence, like I said, on the hourly. So you would have let it run when it's both, and that's why I've zoomed out here deliberately. So when you see the moving averages rising on the price and also the CCI, you let it go, and you take profits when both the price and the CCI start dropping. And what we also look for is any divergence. And back here, you can see there that was a bearish divergence. Higher highs on the price, lower highs on the CCI. That was a bearish divergence. So as soon as you start seeing the price break, that was already giving you a warning when the CCI starts dropping. So if you're holding long positions during that period, when you start seeing the moving averages start dropping like they did here, you would have taken your money off the table at that point there and closed out any positions you might have had in your contracts. Otherwise, you let it run and you actually average down if the CCI and the price are moving in tangent in your direction. Again, going long during that little period and up until that point, that would have been a nice little trade to take. And then closing it out when both the moving averages and the price drop as well. So US crude on the weekly, both price and CCI, well actually the price is below the moving average. The CCI is still in that moving average range. So I would call that a neutral positioning. It's sort of consolidating there. Again, you'll notice here the price moving averages are constricting, and that's a signal of consolidation. What you want to see is the moving averages separate like they did back here, and that would have been a nice area to go short. probably avoid going long during that period because the moving average is still in decline, even though the CCI broke higher. That quickly showed it was still in a decline with those moving averages. On the daily, again working backwards, we try to identify any bullish or bearish divergence, and it looks like the CCI is moving in line in tangent with the price, so there's none there. And again, notice that consolidation, very narrow moving average range with consolidation. Again, I'd like to see that break one way or the other and have a more convincing separation of moving averages like they were back here. You would have gone short during that period. And that's where we go now to the hourly, and we look for any divergence before we move to the back test. So back here, those lows are higher on both the CCI and the price, so there's no divergence. The CCI is already broken above, and the price is just broken above the moving averages. But again, I'd like to see those moving averages start bending up like they did back here, for example. So they're still predominantly in the downtrend on the 1 hour price chart. So looking at the back test, going short on the daily from this period around about the 5th of August, from this period back there, you would have taken some short positions. Now notice here was a bit of a whipsawing effect, up and down, consolidating, and you'll notice here we've maxed out our contracts at 62 at each one of those points when it went against you. But again, what's the golden rule? You always close out your positions whenever you see both the moving average of the price and the CCI go against you. So you would have closed it out there with a small profit at that point, going short again there, close it out again there, and you would have avoided these drawdowns in each of those instances. So make sure you hit that like and subscribe button. If you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across regions of the world's markets. Thanks, and talk to you in our next video.